All right, let's talk about something that sounds completely backwards. We're going to dive into one of the most counterintuitive ideas in all of finance, how making a 2x return, doubling your money, can actually be seen as a total failure. I know, it sounds crazy, but in the wild world of venture capital, that's the reality. Let's break down why. So let me just ask you a really simple question. Imagine you invest, say, 10 grand, and a few years later you get 20 grand back. You doubled your money. Are you happy? Did you win? Of course you did. In the stock market, real estate, pretty much any investment you can think of, doubling your money is an awesome outcome. It is a home run, a clear, absolute win. But not in venture capital. In that high-risk, high-stakes game of funding brand new startups, a 2x return on an entire fund isn't just kind of meh. It's often considered a complete and utter failure. So how is that even possible? Well, the answer is in the very strange, very brutal math that the entire industry is built on. It really all comes down to a concept called the power law. And this isn't about just picking a few solid companies. No, it's about a desperate, all-out hunt for one or two legendary ones, the unicorns. So what is the power law? Well, basically, it just says that in a lot of systems, a tiny, tiny number of things account for the vast majority of the results. Think about Hollywood movies. A few massive blockbusters, your Avengers, your Avatars, they make more money than hundreds and hundreds of other movies combined. Venture capital, it works the exact same way. And what's wild is that this chart here, this is what VCs expect to happen. They go into it knowing most of their bets are going to lose. A VC might invest in, say, 20 different startups, fully expecting that more than half of them, that big 60% chunk, are going to go to zero. Total wipeout. Another 30%, they call them the walking dead, they'll kind of just limp along and maybe give you your money back. The entire hope, the whole reason for the fund to exist, rests on that tiny little 10% slice, the mega winners. And this chart just drives that point home. Look at the impact. All those losers and walking dead, they're actively dragging the fund down. So here's the kicker. That one mega winner doesn't just need to do well. It has to be so colossally successful, so huge, that its return is big enough to pay for all the other failures and still generate a massive profit. A simple 2x return from your winner, that just means it wasn't nearly big enough to save the day. Okay, so if that math wasn't tough enough, let's throw in the second part of this puzzle, the fees. Because even if a fund manages to double its money on paper, that number gets eaten away before an investor ever sees a dime. The whole industry pretty much runs on what's called the 2 and 20 model. Here's how it works. The investors, called LPs, pay the VC firm a 2% management fee every single year, just for salaries, office space, the works. Then if there are any profits left over at the end, the VCs take a 20% cut of those profits. That's called carry. Let's put some real numbers on this, because this is where it gets kind of painful. Say you have a $100 million fund. That 2% annual fee means the VC firm is collecting $2 million a year, every year, just to keep the lights on. Now, a typical fund lasts for 10 years, so that's $20 million in management fees right off the top. That money's gone. Which means for the investors to just get their original $100 million back, the fund actually has to grow to $120 million. That's just to break even. So let's go back to our successful 2x fund. It turned $100 million into $200 million. Sounds great, right? But hold on. The first $120 million of that $200 million is just paying back the original investment plus all those fees. That means there's only $80 million left over in actual profit. For the investors, that is not a 2x return. It's a 0.8x return on their capital. Suddenly, doesn't sound so good, does it? But wait, it actually gets worse. I'm sorry, but it does. Because VCs aren't just competing against their own bad bets and fees, they're competing against the simplest, most boring, and often most reliable investment in the world, the public stock market. This slide, man, this lays it all out. Over the same 10 years, an investor could have just put their money into a simple, cheap S&P 500 index fund and, based on history, probably would have gotten around a 2.6x return. So you have to ask yourself, why on earth would anyone lock up their money for a decade with no way to get it out in an extremely high-risk venture fund with high fees just to get a worse return than they could have gotten from the stock market with a few clicks on their phone? And that's really the bottom line. Investors demand a huge premium for taking on all that risk, for paying those high fees, and for not being able to touch their money for 10 years. A 2x return doesn't just fail to deliver that premium. It's a massive underperformance compared to a much safer, easier alternative. That's why VCs have to shoot for at least a 3x or even a 5x return on their fund just to be considered good at their jobs. Okay, so if the model is so unforgiving and the math is so brutal, you might be thinking, why does this system even exist? Well, it's because this crazy high failure rate system is precisely the engine that allows for world-changing ideas to get funded in the first place.
This quote just nails it. Traditional finance, think banks, is all about minimizing your risk, avoiding failure at all costs. Venture capital is the complete opposite. It runs towards the high probability of failure because it's chasing those wins that are so monumentally huge, they make all the losses completely irrelevant.
Think about it. A bank is not going to give a loan to a couple of founders in a garage trying to build reusable rockets or create an AI that can write poetry. The risk is just insane. The power law model, for all its brutality, is the engine that funds these moonshots, the kinds of radical, crazy ideas that actually push the world forward. And that kind of leaves us with a final big question. This high-risk, high-failure model has given us some of the most transformative companies we've seen in our lifetimes. So, if this brutal math and all these failures are the price we have to pay for that kind of breakthrough innovation, is it worth it? It's definitely something to think about. Thanks for joining me.